Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers and stock recommendations down below in the comments off the chain. I love it. This channel is dedicated to the rational, cash flow hungry investor, and we're going to do something we've never done before. In fact, something I've never seen on YouTube. And I've never seen anyone do in all the analyst research reports that I read in my 30-year history. We're going to take a look at 30 years of financial information on Microsoft this week and see what does this teach us about growth, what does it teach us about the dot-com bubble and burst, subsequent actions, what happened, and how can we take that information and relay it into the current market we have today to figure out, is Microsoft in a bubble? Is the market in a bubble? And what do we do if we are? You ready? I'm jacked. I think it's going to be a lot of fun. Let's get to work. All right, before we get into Microsoft, I want to review the 5 key attributes that we use in this channel to value all securities as a rational, cash flow, prudent buyer that's going to hold the stock for long term. Those 5 key attributes are: number 1, top line revenue growth. You need to have it. Number 2, EBITDA. EBITDA, we use enterprise level earnings. Those need to be growing. Number 3, strong free cash flow, obviously. Number 4, low debt, less than 3 times debt to EBITDA leverage ratio. And number 5, a well-priced stock. Now, a well-priced stock can be a stock with a high PE or multiple. The question is, if I look into the future with a conservative forecast, does the expected return on the investment beat the market? That is our definition of a well-priced stock. We're not looking for the cheapest. We're not picking up cigar butt companies or companies that need turnarounds that are absolutely bottomed out. There's also risk there. We want a company that is reasonably priced. That's all I'm asking for. And that reasonable price needs to generate an excess return above 10% IRR, an annual return, which is what the market, the S&P 500, has done any 10-year period of time in its history. It has returned 10%. We look to beat that metric. Okay, let's take a look at Microsoft. Now, behind me is the Cash Flow Investing Pro one-pager on Microsoft, and I'm going to just thumb through it to show you 30 years of history that we're going to cover, both revenue and cash flow for this stock. I'm going to release this in the channel. Check out cashflowinvestingpro.com for this one-pager. You can see the details behind you, because most of this is going to be very difficult for me to show you on this screen because it is so much information. And it's really going to be fascinating. It's going to cover, this is what the one-page looked like. It's actually so large I couldn't fit it on one page, because normally we look at 10 years of data. I wanted to get a picture of the dot-com bust, so I went back to 1990 through 2001, Microsoft Corporation's annual results. And what I learned is staggering. It's let's dive right into it. So 1990, this is revenue behind me. I've got USD in millions of dollars. So that's 1.1 billion of revenue for Microsoft in 1990. They were making positively, by the way, earnings of $440 million of EBITDA. So what, right out of the gate, the very first thing I want you to know is this is an early stage, 1990, early stage software company, and its operating income is profitable. It's there. A lot of the companies we look at today that are at the stage of Microsoft in 1990, right? They're burning cash. And so this is a difference between then and now that I think is important to take. If I click on through, I have zero debt, no excess cash because they're growing. That's okay. I'm fine with that. I left all our cash on the balance sheet. Market cap, $9 billion. Enterprise value is equal to market cap because there's no debt. And they're trading at 20 times earnings. So it's above market because it's growth, 20 times earnings. They have no debt. The cash flow, the revenue is positive and EBITDA is positive. That's kind of a basic understanding of where Microsoft was in 1990. Now, let's just proceed down the list. I'm going to show you something that I thought was fascinating and I have never seen in the 30 plus years I've been doing securities work. Let me just walk down revenue for a second. So we're at 1.1 billion, 1.8, 2.7, 3.7, 4. You get the idea, right? It's growing. Not only is it growing, but every single year it grows. I'll try to go slow. Again, I'll put this up on the cash flow page, Cash Flow Investing Pro. So here we are. Let's just stop every decade. Sorry. In 2000, $23 billion, 25, 28, 32, 36, 39, 44. Let's go down to 2010, 62 billion. Let's go 2020, 143 billion. Every single year they have grown revenue. In before the dot-com bust, after the dot-com bust, and into this market that we're currently in. Fantastic. I mean, my hat's off to the people at Microsoft over the years that have run that enterprise. They've had lots of different management through there, not lots, but they've had a few different managers over these 30 years. Some better than others, I'll grant you that. But they were still able to grow top-line revenue. Let's take a look at EBITDA as well as the enterprise level earnings that we use. $440 million. 726. I'm not going to do the same thing, but I'm just going to show you the progression. Here, it does slow. It's not every single year they grow, but it does, in general, if you're a long-term buyer, it goes from $440 million pretty consistently. I mean, not every year maybe, every third year, they're definitely higher than they were before. There are a couple periods where they, like here, right? So 33, 27, 30. So there was a down year of a good 10% hit to earnings that you could say, hey, that's it, I'm out of here. But had you waited, right, they rebounded to 30, still down from 2 years prior to that, but then up to 44. So when you're buying a stock, you really need to own it for a long term. But let's continue. 44, 54, 65 to $80 billion last fiscal year. So they went from $440 million to $80 billion of annual EBITDA. That's incredible. Let's take a look at enterprise value. So we're skipping debt and cash flow. I look at that in other videos, but for the sake of time, we have a lot of data here, and I want to get on to some very interesting things. So I'm gonna skip the debt debt cash section because they have virtually no debt. Just focus on the enterprise value. So enterprise value, $9 billion. It grows along with earnings all the way down to the current $2.2 trillion. And there's a couple periods in here where it stalls. And if I look in the 2000 era to 2014 here, right, you can see this is a massive chunk where it's basically hovering around $200 billion, and it really doesn't move. And this is what I want to get to. Let's figure out what happened to the market multiple over the period of time leading up to the dot-com bust and what happened afterwards. So when we reviewed the very first year here, 1990, it's turning at 20.1 times enterprise value to EBITDA, right? So that's our payback period, if you will. And 20x is above normal, so you would expect a little growth here, which definitely happens. But 20x, it comes down to about 14, 12, which is super cheap. And then in 1990 to 2000, it peaks at 41 times enterprise value to EBITDA. That's the peak at the dot-com era for Microsoft, right at the burst, kind of the fiscal year end, 34 times. And then the whole world melts down. Everyone seeks cash. They start selling indiscriminately. The indexes get sold. Microsoft is in the index. So regardless of value, when you sell an index, you sell the good along with the bad. That selling pressure, price falls. Regardless of value, performance, whatnot, the market just panics. And so what you're going to see here is you're going to see a collapse in the market multiple from 34 times multiple down to a low of 6.4 times. That is ungodly cheap for such an amazing stock. So again, it went from 40 times earnings to 6 times earnings. And what does that mean in terms of share price to you as the whole holder? So this is 2010. Dot-com peak in 2000, price was $40 a share. This is 2010, $23 a share. So that's basically a 50% reduction in the stock price as a result of the dot-com burst. And that took a decade to actually happen. So the market melts down. It declines over a 10-year period of time. You continuously lose money down to a 50% of your initial investment. Wow. I mean, talk about a kick in the teeth. There you are a decade later, having put money into Microsoft, you're out 50%. You bought it at $40, it's now trading at $23. You bought it at an enterprise value to market multiple at 40x. It's now trading at 6x. That's incredible cheap. But what happened to the actual company? So these are ratios, and that's the stock price, which is a popularity contest. What happened to the actual business cash flow? Let's check it out. So in 2000, $22.3 billion of top-line revenue, EBITDA $11 billion. In 2010, at the bottom of the market multiple, $62 billion of revenue on $27 billion of enterprise value. What does that mean? That means revenue and earnings tripled, 3x up, while the stock price halved in value. So this is the difference between value investing and what the market does. I like to say the market's kind of like a random number generator. It'll throw a number out there. If you want to buy the stock, you want to sell the stock, sometimes it can be completely devoid of any rational thought. In this case, it has thrown a beautiful stock out. It's now trading at 6 times earnings. As it continued to grow over the decade, you can buy it at a steal at that price. And it's amazing that a gem like this can continue to grow during a economic collapse and a dot-com bust. But what fell is the market multiple, not the business itself. And if you bought the company for the underlying performance, and you're not looking at the stock price, but you're looking at every year reading the 10K, every year you're like, I want to buy more of this stock. It continues to grow. It gets cheaper and cheaper and cheaper over the decade. And then, of course, what happens, right? You continue to hold it. 60 billion of revenue goes up to 168. The EBITDA, again, that's 8 times growth to $80 billion. And of course, market cap goes to $2 trillion. So the long term here is it's incredibly valuable to hold a quality stock long term and know what you own. Now, where are we today? Well, you're paying 24 times enterprise EBITDA to enterprise value, which is not as high as it was in the dot-com peak. Very interesting. So here we are. This is roughly, it's high. It's higher than, say, Coca-Cola should be, or something that's selling individual products. But they've got a lot of products that are subscription-based. They're reoccurring. They've got a 30-year trend of revenue and earnings that have continued to go up. And if I were a betting man, which we are because we're buying stocks, next year's earnings is probably going to be higher than last year's earnings because the entire track record they have demonstrates their ability to operate in good and bad times and grow earnings. That's what we want. We want a company that can demonstrate the ability to grow and that you can then make a bet on that company over the long term. But if that market multiple collapses because we are in a bubble and everyone starts selling indiscriminately, you need to be prepared to own and hold the stock for a decade. So you better read the 10Ks. You better know what you're buying and be willing to own and want to own it for a long time. Okay, the same thing is true when I look at cash flow. Now, I'm not going to go through all of it. I will put this in the Cash Flow Investing Pro website. You can check it out. But the same thing is true with cash flow. Cash flow from operations, CAPEX, right? Positive cash flow free cash flow to equity holders. Number of shares outstanding, positive cash flow, and a yield. So it meets the free cash flow benchmark that we have as rational investors, and that free cash flow only grows over time as you go out, right? So this stock is checking the box all along, and cash flow ends up replaying the same story as the EBITDA. But what I want to show you next is a chart that I think is going to summarize all this for you. Okay, so we just went through a whole lot of data that's difficult to see on the sheet. If you want the detail, check out cashflowinvestingpro.com for the one-pager on Microsoft. Extreme long view, I'm calling it. But as a summary, I've put it together in a visual aid so you can clearly see what I'm talking about. The orange line is the market multiple, the enterprise value divided by EBITDA, our payback period. How many times earnings am I buying this stock? What does that look like over time? And the blue, the dark blue, is the actual earnings of a business that if you're reading the 10K like everybody should, that's what you're judging your business on. That's the number you want to use when you're valuing a company. And that's how you judge your portfolio, not necessarily on price, right? Price is just a indication of popularity versus EBITDA's true weighted value. So what we're doing here is we're taking a look at the orange, the market multiple. Here's the peak, 40 times earnings, the peak in 1990. And then what happens in the dot-com? Well, money floods out of the stock market. Everybody runs for the hills. You have to de-lever because everyone was leveraged at the time, right? So they're canceling their margin debt, they're paying off their HELOCs, they're liquidating, indiscriminately selling the business. Well, that outflow of money is like taking a balloon, taking air out of the balloon. This is whoosh, the air coming out of the balloon. Market multiples drop all the way down to a low of 6 times. That is an incredible point in time to buy Microsoft. And look, it sits there for several years. I don't know, kind of like Intel is now. I'm just saying, take a look at it. So it's sitting there, so this Microsoft sitting there for a long time, and then as the market begins to get over the decade that was lost because of the dot-com burst, people start putting money back into the market, the fury gets going, the popularity gets going, and the multiples begin to climb. But let's look at EBITDA. Here is EBITDA, actual earnings. Every single year it's taking class. Here's the collapse, and look what happens. EBITDA continues to grow, and you only find this if you put down CNBC, if you put down the Bloomberg News, if you turn off your phones, you pick up a 10K, and you read it and you think about it. What I like to do is any stock that I own, I like to request that I get a physical 10K every year, or the annual report mailed to me, if they'll do it. And then when it comes in the mail, I know I have to read it. I don't have to think about their fiscal year. I sit down and I read it. And yes, there are times when the business is going to go sideways, but that doesn't mean you sell it. Don't get in the mood of just dumping and chasing the herd. You need to buy a business that is fundamentally growing a long time. And when it stalls like this, but you think the industry is going to grow, you got a good management team, you continue to buy. This is dirt cheap. So anyways, long story long, I wanted to point this out to you that I think looking at a 30-year track record is something that no one is talking about, and it lets us compare the dot-com bust to where we are today. And it's likely that we could see a little bit higher market multiple growth, right? It's likely that it could come down, and if it does, the stock price is going to fall, and you will have negative return on your investment for potentially a long period of time. But if you understand the business you're buying, hopefully you can weather the storm. Okay, let's forecast Microsoft at this level and just see what we're dealing with. All right, so here's our forecast for Microsoft. EBITDA, I'm picking it up from last year. I'm going to grow it at 21.5%, and I'll bring down that growth rate over time because they're just getting so big, the growth rate's going to slow. I'm using this growth rate, which is just generally what they've been growing more recently. I didn't use the full 30-year history. I put the more recent period of time to grow it. But they're growing very strongly in recent years. I'm going to bring that down. So they're going to go from basically 100 billion to $387 billion of EBITDA a year. It's incredible just to say that. I put a 21 handle on it. I mean, this stock has, apart from the decade kind of washout, which happens, but how are we supposed to predict when that's going to happen? 21 is something they've maintained for a long time. You saw 1990 there at 21 enterprise value. I'm using market multiple the same. And when I do that, that gives me an $8 trillion market cap. I know the numbers that we're throwing around are crazy, but the federal government has printed 10 times the money supply. So yeah, we're going to see numbers that are a lot higher than we used to see. So $8 trillion divided by the outstanding share, you get $1,000 a share. $1,000, $86 a share. If I use the same kind of methodology for free cash flow, $8.46. I didn't go through all the detail in the free cash flow sheet. You can look at earlier Microsoft videos that I've done. Again, you can reference the cash flow investing website. I have all the detail there, but I'm trying to move this video along for you. So it goes from $8.46 to $33.38. I apply an average yield to it for a stock that is growing at this kind of rate, and I get just under $1,000, $953 per share. If I were to look in the stock market today and figure out what can I buy Microsoft for, well, I can buy as much as I want at $333. Right? That's the random number that's thrown out there in the market that I like to say. Mr. Market is what Benjamin Graham called it, but it's kind of like a random number generator. You never know what they're going to throw out. So I can get all I want for $333. What I think it's worth is basically $1,000 out 10 years. So if I pop that into a quick IRR, I buy a company for $333. I own a company that's going to generate cash flow, whether they give it to me, whether they acquire the stuff, it's my pro rata ownership. So I'm going to count it against or part of my investment. And in the end, I'm going to sell this for $1,000 a share. And that's a 17% IRR, which is a solidly outperforming stock for this market. And I think, is it a little pricey? Yes. But it's kind of always been pricey. Aside from huge washouts of the market, you having this in your portfolio, I think is still a good stock to have. If I put this on a distribution curve, right, as the stock goes up and we assume the same performance, the return comes down. If it should fall in price, the return goes up. If we have some sort of washout, I would expect market multiples to come down. I expect your entire portfolio to come down, and you're going to feel bad. So make sure you're reading your 10Ks. Make sure you understand the business. Make sure you have low debt. Because when the markets wash out and you can no longer IPO or issue shares at robust values, it's very hard for companies to raise capital, raise money, to fund losses. And if they run out of cash, they can't raise equity and they have debt to pay. That's when you get the risk of bankruptcy. That's why we look for less than 3 times debt to EBITDA. Here, they have almost no debt. In recent years, they've had some debt, but they have so much cash, it's fine. So you want to have a stellar balance sheet because you don't think about it until you need it. It's kind of like a legal contract. Nobody likes to negotiate them, but when you suddenly find yourself in a fight with a vendor or someplace, you're glad you had the contract. All right, let's recap the 5 key attributes here. Top line revenue growth, growing, absolutely. EBITDA, yep, it's growing. Strong free cash flow, yes, it's there. Well, low debt. Yeah, they have less than 3 times debt and well priced. I think given the IRR, the risk-adjusted return here, it is well priced. The history we've seen is they've been able to grow in good times and bad. And if I were a betting man, which I am, I would bet that they would grow into the future. Do they hit the exact forecast here? I don't know. I have no idea. But can they achieve this basically tripling, almost quadrupling of EBITDA? Yeah, I think it's totally possible. Is it going to happen in 2030 or 2040? I don't know. But I know that my money most likely will be higher in the future with this company than lower. I think that's a very safe bet. And so I'm willing to bet on this forecast and try to get to this number. If it happens sooner, then I have a higher return. If it happens later, I have a lower return. But at least it's going north, which is the direction I want it to go. All right, this has been the recap, the 30-year recap of Microsoft. I hope you really like this. I hope you learned some lessons on our 5 key attributes, why we use them, how we could have bought this stock in the 1990s or in the washout in the 2010 range when it truly bottomed and you would have had an amazing investment. The last thing I want to point out to you is the trifecta. And what is that? Well, the trifecta is my term where I look at earnings growth, it's enterprise growth, market multiple expansion, which is enterprise value EBITDA, and buying back shares. And Microsoft exhibits that pattern. If you would have bought it here at the low point at 6 times enterprise value, you would have had a company who was growing naturally their earnings, the blue bars naturally growing. That's growth that's normally growing for the stock price. And then the market multiple, the number of times the market's willing to pay for the earnings that you're already owning, is also going up. That is a compounding, and that's how the stock price ends up going like this. This is price per share that's on the cash flow one-pager that I give to my club on the website. So how do you get this parabolic move in a stock? Well, that is the combination of both earnings growth and market multiple expansion. The last thing is share buybacks, which I'll show you here. This is, let me lock this so you can see. So shares up top, if I come all the way down to 2020, in this period of time, they are buying back shares. They're using all their free cash flow to chew up shares. And that's the third element in the trifecta. You want a company that's growing earnings, enterprise level, not earnings per share, enterprise level earnings, whether operating income, EBIT, EBITDA, whatever number you want to pick, but that upper level number. Then you want a company that you buy at a low multiple that you're ahead of the crowd. The crowd sees it and says, oh, I want this company. Then the market bids up the multiple. That's the next leg you need. And the last leg is buying back shares, because that means the one share you bought back in the day has a now greater ownership stake in the company, because there's simply fewer other competing shares out there. That's the trifecta. That's what I like Microsoft for, or that's what we look for. Is that going to happen going forward? I'm not sure, but I do think the IRR is worth it. That's why we hunt for value stocks in the 6 times multiple range. This one gets a good for us. I really hope you enjoyed the presentation. If you would like to learn how to do this work for yourself, there are literally thousands of stocks in the stock market. There's more than 3,000 stocks just in the US. There's tens of thousands globally. You can do this for yourself. Most stocks have no analyst coverage on them, and therefore there is true value out there for someone who can read 10Ks, pull out the salient material, populate a sheet like this, build a simple forecast, and guess at a return. That is an amazing skill that will serve you for the rest of your life if you learn how to do it. And I highly, highly recommend you check out my website, Cashflow Investing Pro. Consider buying my course, my investing course for $300. I will give you this Excel template. Well, the standard one was 10 years, not the 30. You can just expand it if you want to, but it'll have 10-year historical financials. I give you Apple's 10Ks. I pick through Apple, piecing it together. We build a forecast on Apple, and then we assign market multiples based on history, and we come up with an estimated price. And you can do this yourself. Know the stocks that you own, so when the next collapse happens, you know what you bought and you're willing to hold it, potentially even lean in and buy more of the best companies. That's how you make money. You own a focused portfolio of stocks that you know and understand and believe in. I help you do that through some basic tools. Check it out if you want. Once again, my name is Cameron Stewart. This is Rational Investing. Really appreciate the time and effort, all the comments. Let me know what else you want to see in the channel in the comments below. Don't forget to hit the subscribe button. Really trying to grow the subscriber base in 2022. Thank you very much for the time. Have a great day. Bye-bye.